Hi, this is Alan Gassman. I'm at the St. Petersburg College Studios on the 50th floor of the St. Petersburg College building in St. Petersburg, Florida, with Jody Craig and Jerry Hesh. And we are here to talk about life insurance planning. We're going to talk about term life insurance. We're going to talk about charitable and non-charitable life insurance. And I couldn't think of two other people that I would rather have with me for this presentation. Jody Craig, a new friend that we're meeting today, and Professor Jerry Hesh, one of the foremost authorities and one of the most likable people in the United States of America when it comes to life insurance. And I even got him to smile just now. This will qualify for Florida lawyer continuing professional education, and for Florida CPAs, we will give you a certificate. We welcome your questions. I will be watching the question panel from time to time so that we can try to answer your questions as you have them during the presentation, if you manage to stay awake for this. Now, please note that we have a number of presentations we've already given here. We talked about the new charitable laws on March 17th. We did a survey of charitable gifting vehicles on April 21st. We talked about private operating foundations on June 16th. And those are all available for replay. You can click there, you can go to the YouTube channel and enjoy that. And then on July 21st, Michael Lehman of New York City is going to join us, and we're going to talk about charitable planning for the business owner. We do appreciate St. Petersburg College's sponsorship of this. These webinars you can find on our law firm's YouTube channel. We have a whole row for charitable giving. Please go there and visit it and enjoy that. By the way, Saturday, I'll be continuing my Saturday series on trust for laymen and experts. Brandon Ketron and I are going to talk about trust structures and strategies Saturday at 11. No continuing legal education credit for that. Jody, who the heck are you and what do you do?
I am a major gift officer for the St. Petersburg College Foundation. The St. Petersburg College Foundation is the fundraising and advancement division of St. Petersburg College. Just a little background of that is that, St. Petersburg College has been around since 1927. We're approaching our 100th anniversary here in a few years. We have 11 campuses or learning sites all throughout Pinellas County, Florida, around 49,000 in enrollment. We were the very first community college in Florida and the first community college to start offering four-year degrees. Our foundation, just to understand the size of our foundation, we have around almost $97 million in assets and endowments, and we manage more than 350 scholarship and program funds for the college. And each year we give around 2,600 scholarships to students and $2.5 million in support for students.
That's great. And we know by the numbers and by reality that students who live modestly and attend the college of their city or their county have really good track records on getting into graduate school and being very responsible professionals. So, yes. Jody, we really thank you for all your efforts and your dedication to our local college. Jerry Hesh, if you ask 100 estate tax lawyers, who was your favorite estate tax professor and who gave you the most motivation to go forward and join the profession, Jerry Hesh will get the most votes for a very good reason. But Jerry, I wanted to ask you where your passion for the taxation of charitable giving comes from. Does it come from the fact that it's a very interesting and complicated area, or does it come from the fact that you like to help people structure millions of dollars into charities?
Yeah. Well, what was interesting is when I started working with various charities, they really use the standard promotional materials. And because of my my so-called math background and financial background, I kind of said to the charities that I was working with that, you talk about these things in general terms, but what would really be nice is if you can do financial projections to kind of illustrate how the charitable planning can actually work, the financial benefits. And what I end up typically showing is that if you do a properly structured, custom designed charitable planning technique for your unique situation, what you end up giving to charity really doesn't have to cost you anything. What I try to show the clients is very simply a properly structured charitable giving technique. It's not your own money. It's what you would otherwise pay in income taxes and estate taxes that you're giving to charity. And when you can show that in simple to follow numerical examples, it becomes a lot easier to communicate this and encourage people to do charitable giving. So that, that's how I kind of got interested in it, because it's not what you know, but your ability to communicate what you know in an understandable manner. And the easiest way to do that is simple to follow numerical examples.
Yep, and you are very famous, and it's a very effective way to demonstrate how charitable remainder unit trust works, charitable lead annuity trusts, and other structured planning, which we have on other videos. So thanks very much, Jerry. And we do have a page here on page 9. If you'd like to donate to St. Petersburg College, if anyone donates $10 or more to St. Petersburg College today, by the end of today, and send me an email that you did, I'll send you one of our books. You can pick any book in our Amazon library, and I will send that book to you by mail in physical form so that you can burn it during the summer in your fireplace to create warmth, or actually read it, because there are things called books that people actually read. Page 10. I wanted to talk for 10 or 15 minutes just about term life insurance in a very simplistic but practical way, because we find that a number of both sophisticated and unsophisticated clients and many advisors don't realize everything that's going on in the term life insurance world. Now, I think everyone knows that a life insurance policy is a contract between an individual, typically the person whose life is going to be insured, and a life insurance company. And that the life insurance company wants to know about that person's health and would like to know that that person has a nice long life expectancy, because the life insurance company is banking on the fact that most people don't die right away, and most people, as a matter of fact, eventually drop their policies and never get any death benefit at all. And if that didn't happen, then the life insurance companies would have to charge a lot more in premiums, and there would be a lot less life insurance out there to go around. The term life insurance policy is a fairly simple contract. The carrier says, if your application was accurate, and if you sign here and pay your premiums, then if you are lucky enough to die during the covered term, we will deliver a check to your beneficiary of the death benefit. And with a strict term life insurance policy, this will typically be only for a term of years. 10 years, 15 years, 20 years, 30 years are all common. And I'm going to show you how the rates can change when you make that decision. But there's more to the contract than the premium amount, the death benefit, and the term of the policy. And we're going to talk about that in a couple of minutes. Now, before you buy the policy, you fill out an application. The carrier wants to know your medical history, normally for the last 5 years, and they are going to verify this by getting this information directly from your doctors and from certain facilities, because they're not going to take your word for it. And they're going to send a nurse or an equivalent person to the home or office of your choice, typically early in the morning before you start work. You haven't eaten anything the evening before, and they will put you on a scale and get your weight. They'll take some blood, they'll take some urine, they may do an EKG, and they will take a questionnaire from you and whatever information you give them, and that will go to the life insurance carrier. Now, if you fill out a formal application, then the results of your questionnaire and your physical will be posted to the National Bureau. And all of the life insurance companies in the United States, whenever they see you, they are able to go to that bureau and see anything that you've done in the last 8 years. So you may request that you not provide a formal application. You may request that you provide what we call an informal application with the carrier, where the carrier will agree to keep the information strictly confidential and not post it to the bureau unless or until you have understood the results and authorized them to do so. So the first thing I encourage clients to do when we have this discussion is ask the agent who you want to work with whether you can do an informal app. Because, you know, if you ate a bagel with poppy seeds the night before your blood test, you may come up with the same chemical that goes into heroin. Or if you accidentally ate a few gummy bears a few weeks ago, that marijuana may still be in your bloodstream, and that will be printed to the bureau. So you may also have a glitch on the EKG that is very, very rare. So I like to keep this information confidential. Not all the carriers are willing to do that, and you may end up going to a different agency so that you can find one who will do that. Now, getting pricing for your term life insurance in advance is sort of like going on a date with somebody by a 10-minute telephone conversation. They really cannot rate you and size you up and give you a real price until they have all of your medical information. So it's almost a waste of time to call different agencies and ask for rates, because the rates are going to vary based upon your health. And some insurance carriers will charge a lot more than others because they're more concerned with the health information. So you take your physical and you get your proposals usually 8 to 10 weeks later. And one of the things you want to think about is how strong these life insurance carriers are, because the carriers with the lower rates are typically less strong than the carriers with the higher rates. To my knowledge, there has not been a failure of a life insurance carrier in the United States that has caused loss of death benefit. But we have had failures of life insurance carriers in the United States that have caused inaccessibility of cash value, and quite candidly, some pretty scary experiences that I've seen with clients who bought a lot of life insurance with a company called Shenandoah Life. Shenandoah Life went into receivership, and my clients could not touch their cash value and ended up in bankruptcy because of that. So we do want you to check out your carriers. And if you're going to buy $10 million of term life insurance, why would you buy it all from one carrier? Why not buy it from 5 different carriers? And yes, every carrier is going to tell you that they're perfectly safe, and most of them today are perfectly safe, but we don't know what the next economic tsunami is going to bring. Now, hopefully, when you buy your policy, you will get advice from your estate planning lawyer or other professionals on who should own the policy. And most often, the owner of the policy will be the person who is insured by the policy, and they'll make it payable to an individual who they expect to receive that money when they die, or a trust for children. So quite often for our clients, there will typically be a revocable trust of the spouse 1, a revocable trust of spouse 2. Spouse 1 will own her life insurance, and make it payable to her revocable trust. And then spouse 2 will be the beneficiary of the revocable trust. And if spouse 2 doesn't survive spouse 1, then their children could be the beneficiaries of the revocable trust. But if the policy is made directly to the children and spouse 1 dies, if the children aren't adults, then when they're 18, they're going to receive it from their guardian, whether they're mature enough or not. Or if they receive it when they're 21 or 25, they may blow it and then not even have enough money to go to St. Petersburg College. So you want to be very careful and circumspect with respect to where your life insurance is going to be payable. And then we find that many clients who come to us for estate planning just don't have enough life insurance. So we think about, well, how much life insurance do you need? Well, I'd like to have the mortgage paid off if I die. Oh yeah, we just bought the vacation home. I'd like that mortgage paid off when we die. How much will college cost for my son who's age 8? A boatload. And my boat has a debt on it too, speaking of boatloads. So how much life insurance do you need to have? And the cost, of course, is going to be an important factor. So here's a 40-year-old male, preferred health, thin, fit, exercises, no major diagnoses, a 20-year $1 million term policy, $865 a year. In standard health, non-smoker, but fairly healthy, 20-year term, $1,500 a year. Healthy smoker, what's the cost of a cigarette? $4,345 a year. What does that tell you about smokers? They're not expected to live as long. Now, a 10-year term policy, only $925 a year. So you have the rates here. You can keep these in your conference room. You can show them to clients. Because if you're an estate planner or you're a CPA, my recommendation is that you spend enough time with the clients to make your recommendation based upon the famous question, what would I do if I were you? I'm not a mathematician, I'm not a CPA, I'm not a life insurance professional, but you're paying me for my time, and I'm telling you, if I were in your situation and I was in preferred health, I would have no less than $4 million of life insurance. You only have $2 million. Can you please go get some more? Well, what will it cost? Well, I'm not sure what it'll cost, but let's look here. You're age 50, you're in decent health, probably $3,500 a year per million. Why don't you go ahead and do it? I would like for them to make a tentative decision before they leave my office so that they have a sense of direction. And I will base that decision on the minimum death benefit that I believe they should have and the term rates, because they may go out and call the insurance agency and get quoted the permanent rates, which are much, much higher. And then they may not realize the benefits of permanent and just buy less term. Please get them to understand that death benefit that they need. So how much life insurance do you need? I like to start off with the 4% rule. My 4% rule is when you die, if your beneficiaries invest wisely and live just on 4% of what you've left them, then that should last 100 years or longer, based upon all the experience since 1932 of the stock market and computerized Monte Carlo analysis. Now, one of my close friends that I have a lot of respect for, Michael Davis, says, do this. Be able to live on 3%, but go ahead and live on 6%. And that should last, but if things go badly, you may have to throttle back. So if I have a client who has a spouse and children and would like for them to be able to live on $80,000 a year for the rest of their lives, he feels that's all they need, then he needs $2 million on death. If he only has $500,000 at the time, then he needs $1.5 million of life insurance. But if he also wants to prepay for college for an 8-year-old, I'd say get another $500,000 of that life insurance. I want the client to walk out my door understanding what I think they need, so at least they have something to go for, a sense of direction. So I invented a spreadsheet with the help of a college student where a client can see by spreadsheet what their whole situation is. The first question being, and by the way, if you send me an email with the RE line NEST, N-E-S-T, I'll send you this spreadsheet. It's a regular Excel spreadsheet, but it's all pre-programmed. So you have a husband age 49, a wife age 52, and based upon where they want to be when they reach husband's age 70, they want to reach 6,693,000, which adjusted for inflation at 3.6% would be about 3.2 million now. They want to have a $750,000 house that will be worth $1.5 million at that time. They want to have a $250,000 vacation home. They need $296,000 when their child reaches college in 9 years. They plan to pay $150,000 for a wedding in 12 years. So their total needs for the 20 years from now, $8,260,000. A lot more than they were thinking because they hadn't thought about the college and the wedding. So what do they have now? They've got $1.5 million of investments. They have a home. They have no vacation home, and they've got some debt that needs to get paid down. So the total needs that they have after you take that into account, $8 million. So how are they going to accumulate that $8 million over time? And by the way, if they die in any given year, how much life insurance are they going to need on top of what they presently have so they can still make the goal? So for this particular couple, here's what we came up with. If they want to retire, and this was a 30-year-old actually, if they want to retire at age 55 and they expect 6% growth in their investments, they need to save $193,000 a year. If they will wait till they're 60, $130,000 a year, till they're 65, $90,000 a year, and then we look them in the eye and we say, how much are you saving now? And some people say, well, we're saving $200, $225 a year, we're good. But a lot of people, one spouse looks at the other and says, do you know what we're saving? They say, the other one spouse says, I'm not quite sure. Well, that probably means they're not saving enough. So that's part of the life insurance discussion, because the life insurance is to plug the gap of what your family needs, what it'll be short of. There's other purposes for life insurance that we're going to talk about, but the main purpose for most married couples is to make sure that the surviving spouse is adequately cared for and that the children can be educated and have a good start on their future. One other thing I want to mention on the term life insurance is find out when the deadline is to convert the policy to permanent, because most 20-year term policies can be converted to permanent if the policyholder is not healthy, but they typically have to be converted in year 11, 12, 13, 14. They all are different. So when you're comparing two life insurance policies, ask what the convertibility deadline is. It's worth more if the convertibility deadline is farther up. And if you're an estate planner, I recommend that you schedule a visit or communication with your client for 1.5 years before the convertibility option runs up to remind them to go ahead and get a replacement policy if they think that they need one. So Jerry, anything to add to all of that?
Most people who are younger, still working, have children, they basically are looking for term insurance to replace the salary or the wages they would have earned while they're living. And when they're young and healthy, they can get they say, look, I want enough money until my young kids graduate from college. That's 20 years from now. So let me get a 20-year term insurance policy, which makes a lot of sense because they don't have to build up any cash value, and all they do is have to pay for the cost of the actual insurance protection. But they should always make sure that there's a convertibility feature, because what happens is 15, 20 years from now, when the term insurance is about to expire, and there's a convertibility feature, and all of a sudden, over that period, your health has deteriorated, you can actually convert it to a permanent policy based on your prior very healthy status from many years ago. So anybody who takes out a term insurance policy, always make sure there's a convertibility feature in it, just in case your health deteriorates.
Very good. Let me also mention, if your client's going to get $2 million of insurance, but they may be able to reduce the insurance going forward as they stockpile their wages, ask the carrier, ask the agency, is this the type of policy that I can reduce the death benefit for? And if not, instead of one $2 million policy, maybe I should get 4 $500,000 policies, or 3 $500,000 policies and 2 $250,000 policies. The costs are not much more when you buy multiple policies, but then you have the ability to reduce them policy by policy. So Jerry, I'm left here with about 33 minutes, also known as 6/7 of a billable hour. So I have slides for what permanent life insurance is, and then I have your slides for charitable giving. What would you like to do next?
Well, let's talk about that. The first slide that I told you to put in a little introduction in. Where is it? Okay. It's a very simple situation. You have an individual who has been a substantial donor to her favorite charity for many years. And every year she has given thousands and thousands of dollars to her favorite charity. And basically, her intention is to, have her children continue that. But if she leaves everything to her children, there's no guarantee that her children will actually take the money she leaves them and start giving money to charity. So she says, look, every year the charity has been depending upon me. I've given them 5, 10, 20, or whatever I give them every year. There's a possibility my children will not continue that. So what she should do is basically get a life insurance policy on her life that is owned by the charity. And then when she dies, the charity gets the death benefit and replaces the amount, and it continues the amount that she was giving while she's alive. So basically, what she can do is, and she doesn't want to create a charitable remainder trust or some of these complicated charitable trusts. So very simply, she basically can say to the charity, I'm going to give you a small amount of extra cash each year, which is an anticipation of what I would have given you in the future. And you use that annual amount to buy a life insurance policy on my life. And the charity has an insurable interest because she has been a substantial donor. So the charity she can fund it by making cash gifts to the charity, and the charity can use it to pay the life insurance premiums. So it's a very practical solution. Now, if she happens to die early, it becomes a home run because she doesn't have to continue making the annual gifts to the charity to pay the premiums, because the death benefit will kick in earlier. And the key here is by having the charity buy the life insurance policy, instead of her having the money in her own investment account, the income that she would otherwise use to make the annual charitable gifts can be in the charity inside the life insurance policy, so the investment income can be income tax free. So it's actually better off to actually fund your charitable gifts through a life insurance policy than just have an investment account and give the money from the investment account. And then the other thing is very interesting is, once the charity has an insurable interest, it is not unusual that the charity can actually have additional death benefit. Let's say she gives $1,000 a year to the charity to pay a premium. So the charity gets $1,000 and the charity says, hey, I want to pay $2,000. So the charity can get a bank to lend her the other $1,000, the charity can get a bank to lend them the other $1,000 so to increase the death benefit. So financially, this can actually increase the amount that you leave to a charity.
Jody, how does this work in the real world? Do you have conversations with donors about who give you money every year and about whether the life insurance would be something that they may want to give?
It is something that our donors are doing more and more, to use life insurance as a plan giving vehicle, because it's one of the easiest ways to create that first, kind of cut your teeth on a planned gift, or to enhance a current gift, as the professor was speaking of. Is that, like recently we had a former board member who established a scholarship, and he's making that annual gift to keep that fund active. But he also let us know that he has a life insurance policy so that at some point he can endow that scholarship. So it's not, so when that annual gift goes away, whenever he passes, then we have that life insurance benefit to endow that fund. And also seeing that it's also something that maybe a younger donor may take advantage of, rather than make an annual gift to our foundation of $100 or $200, or that monthly gift, that they're making that gift to, or they've taken a life insurance policy that maybe one day it'll be a transformational gift. But at this point, they haven't built their wealth, and so this is an easy and affordable and viable way for them to make a planned gift to our foundation.
Do you know offhand the numbers for the ex-board member, or not the phone number, but the financial numbers of what that pledged amount is, how much scholarship it's generating, and how much the life insurance policy is? Or can you give us
I don't know the exact amount, but he does not have an endowed gift at this time. He makes an annual gift to keep it active, and you must make at least a $25,000 gift to have an endowment with our foundation. So I imagine it's at least $25,000. But that's another good point, is that it is important, and we always appreciate whenever a donor talks to us about their life insurance policy up front. So one, we understand the intent of their gift, but two, also kind of understand the amount and be able to talk to them about this amount, can fund these things, and then we understand the intent of their gift. But many times we don't know that there's a policy out there, with planned gifts. But it is always amazing whenever we do, so that we can create, put something in their constituent record, or go ahead and create, some sort of gift agreement or scholarship agreements that will be active once they pass and we receive the benefit. Then we understand the intent of their gift.
Very good. Jerry, anything for the second slide here?
Okay. Let's see. Yeah. All right. So basically, the simplest solution is to just give some extra cash. Like someone is giving money to charity, and they give another $500 a month, and the charity's got $6,000. Then they can use that cash to use the $6,000 to buy a life insurance policy, which can be in the $30,000 to $40,000 range, or even more. The problem with is existing policies is there's a special rule in the Internal Revenue Code that says if you give a life insurance policy that you own away by gift to a private individual or a charity, and you die within 3 years after making that gift of the policy will be included in your gross estate. So for people where death is imminent, there's no estate planning advantage to it. But for people who are in good health, even if you're in your 80s and you're in good health, you're going to live another 7, 8 years. So basically, either way, you give the money to the charity and they buy the policy. That's the easiest, no frills way. You get a cash charitable deduction. And we did something where someone increased their charitable gift by $500 a month. And the charity used that extra $6,000 to buy a life insurance policy. It was that simple. If you have an existing policy, you have to wait the 3 years, but it still works.
Why do you have to wait the 3 years, Jerry?
Because there's a special rule in the Internal Revenue Code that only applies to life insurance policies. Because remember, the life insurance policy, let's say the death benefit is $1 million and the cash value is $200,000. So if you make a gift of it, it's the $200,000 cash value. And people would like who they know death is imminent, gifted at $200,000 as a gift to their kids, and the kids collect the $1 million death benefit a year and a half from now, and they've avoided all the difference between the $200,000 and the death benefit being exposed to gift and estate taxes. So that rule was designed to prevent people from gifting away life insurance policies when they know death is imminent. But it applies to all gifts, including gifts to charity.
But if the charity gets the death benefit, then doesn't it wash? They have to put the whole death benefit in their estate, but they get the charitable deduction.
Then you get the charitable deduction for that. The only problem is you lose the charitable income tax deduction that you took up front.
Okay. I see. Okay, that's a really.
Oh yeah, that was one of the things I was going to correct in your slides.
Okay. Thank you. All right.
But by the way, what's very interesting is a lot of people have taken out loans against their cash value. And let's suppose that you have a policy with a $200,000 cash value that you borrowed $50,000 on. So essentially, when you gift the policy, it's as if you sold, and the charity takes over the loan. When they take over your loan, that is an income tax realization event. So to the extent that you transfer the policy subject to the loan to the charity, you're deemed to have sold that portion of the policy subject to the loan as a sale, and you'll have income tax to pay because it's the sale of a portion, and you'll have gained the report. So you got to be aware of that. Just a little trick, a little gimmick. It's a little obstacle you have to deal with.
Now, Jerry, if the charity takes over the loan, is there any chance that that's considered to be what they call a transfer for value, and then on death, the charity has to pay income tax on the death benefit, or they're immune from that?
I think there's an exception in the charitable transfer for value rules. But if you transfer a policy subject to a loan to a family member, there's no exception to the transfer for value rule.
A lot of traps out there. So, Jerry, what are these charitable split dollar arrangements?
Oh, crazy. Let me think here. Hold on. Oh, yeah. There was an abuse that was very prevalent in the 1980s and 1990s, where people would basically, have the charity own a policy, and they would basically retain a right to what they invested in the policy. And because of the way the tables were used, the standard tables, you could actually get a charitable income tax deduction for a substantial amount up front, but the amount passing to the charity when you die could have been far less than the actual amount that these arbitrary tables computed. So Congress in 1997 decided to eliminate that and basically have a general rule that's and hold on. Oh shit.
Yeah, you froze there.
Okay. Am I up now?
Now you're good. Yeah.
Yeah.
I'm not going
We're
to touch
saying
anything.
Congress
I just
passed-
inadvertently hit my mouse.
Oh, okay. You were saying that Congress passed a rule that prevented charities from co-owning life policies with individuals under split dollar.
The idea is because this was a gimmick, and it basically, because they were using old term insurance costs, and eventually what would happen is you could have a policy with $1 million death benefit, and say the premiums on the policy were like $300,000, and you think you have a right to the $300,000 that you pay, and the charity would get $700,000. So if I have $1 million death benefit and I pay $300,000 of premiums, and I have a right to be reimbursed $300,000 of premiums when I die, the charity would net $700,000. So you would take a $700,000 charitable income tax deduction. Well, because it used mortality tables that were arbitrary, the amount going to charity could have been next to nothing. So all of a sudden you were getting like a $700,000 charitable deduction when the charity gets maybe $100. That's a little ridiculous. So Congress basically said this is abusive. So they enacted a statute under Section 170 F10, which basically said that we're not going to respect any of these loan transactions, which is called a split dollar transaction. If you pay the premiums on an annuity or a life insurance policy, you can contribute an existing policy to the charity, but if you continue to pay the premiums on the policy, it's going to be disregarded. And in addition, the charity can be hit with a excise tax equal to 100%. There's an exception for charitable remainder trusts, but you cannot use a life insurance policy where you continue to pay the premiums in a charitable lead trust or an outright gift to charity. Okay, and the rules are pretty technical and complex, but there's a lot of what I call promoters out there who are trying to disguise the payment of the premiums in indirect ways and saying, oh, we're going to read the statute literally, and therefore you haven't paid the premiums, your partnership paid the premiums, but in effect, if you use substance over form, it's just a gimmick.
So the only kind of policy I can put into a charitable remainder unit trust would be a fully paid policy that had no more premiums that needed to be added?
Oh, no. If you have a charitable remainder trust, and the charitable remainder trust provides that the entire death benefit goes to charity, that's accepted. So what we frequently, and therefore you can continue to pay the premiums on that policy and get a reimbursement of the premiums paid. So let me say, let's do it in a simple example. Because remember, Alan, I learned a very hard way that it's not what you know, but your ability to communicate it. So let's suppose that there's $1 million policy and I want to pay $300,000 of premiums on that policy for the charity, and it's in a charitable remainder trust. I can get reimbursed the $300,000. No. I don't. I'm sorry. If I pay the $300,000 and the entire $1 million death benefit goes to the charity, I can still take the $300,000 charitable deduction and not run afoul of the rule that Congress enacted in 1997. Okay, but you have to remember that the entire death benefit must go to charity. So sometimes what we do is we fund the charitable remainder trust with like 600,000, use 300,000 to pay for the premiums, and the entire death benefit goes to the charity. You don't want the entire amount in the charitable remainder trust to be used to pay the premiums, because that creates that eliminates a lot of the advantages of charitable remainder trusts from a financial point of view.
So if it's a 20-year charitable remainder unit trust and you die in year 18, the charity gets the death benefit in year 18.
Yeah, exactly.
Okay. All right.
Now, Jody will go into all the minutia on that and translate for us.
After she gets her PhD in astrophysics, right?
Yes, yes. Jody cannot do that.
Okay.
But one of the things is that you use as an introduction, and I use a nice simple example, if you want to benefit charities. If you have a properly structured charitable trust, you could lend, say, $1 million to that charitable trust at, say, 2% interest, or $20,000 a year. And the charitable trust takes the $1 million and invests it, say, at 5% or $50,000 a year. So basically, the charitable trust has borrowed $1 million from you at 2% annual interest, and they invest it at 5% or $50,000. So every year the charity earns $50,000, pays you $20,000, and the charity nets $30,000. And basically you have, now of course you don't get a charitable income tax deduction because the charity is treated, but it's basically a situation that the charity can basically borrow money from you, invest it at a higher rate of return on the interest rate, and the charity gets this 30,000 spread. So you don't have to give the charity the entire $1 million. It's just a loan that pays you 2%, and the charity earns 5%. That's a nice simple way of explaining stuff without getting into the details.
So I guess that's a public charity without prohibited transaction issues. Because if you
you can't do it with a private foundation.
Can't do it with a private foundation, but I think you could loan money to a private foundation at 0% interest. I think that's one of the exceptions to the
that might be
foundation rules. But do you see, Jerry, a lot of charitable remainder unit trusts with a inexpensive universal life wrapper product to prevent income under the NIMCRET type rules? Is that being used commonly?
No. The reason is you can't just throw the policy in there. You have to do the financial analysis to basically custom design it for each situation. And that requires a lot of work. You have to do the analysis. You have to figure out what kind of policy, how to carry it and everything. And a lot of lawyers don't want to devote the extra time and effort, like the 20 or 30 hours that it might require. That's why you have Jody to do all the analysis.
Exactly. But I did see there's a private letter ruling from 1992 that shows you how to draft a NIMCRET that owns life insurance and does not become a defective grant or trust for income tax purposes. For the tax professionals on this webinar, there is a way to do it. You have to just make sure that the trust does not allow principal to be used or income from the policy to be used to pay the premiums on the grantor's life. So That might be interesting. Now, Jerry, do you have any familiarity with the charitable lead trust plan where a charitable lead trust would receive ownership of a life insurance policy? They call it the Enhanced Charitable Lead Annuity Trust, the ECLAT.
I'm not familiar with the term, so, but I'm probably familiar with the technique, but I don't know about that term.
Okay. Have you seen life insurance placed in CLATs, or it typically would not be a good match?
Well, what I've seen is structures where they put the money into a partnership, okay? And then they contribute the partnership interest to the CLAT, and then they say, oh, the insured isn't paying the premiums, the partnership is paying the premiums. And they use the partnership as a blocker entity, okay? And of course, you know, that's substance over form. But there's a lot of these charitable lead trust proposals, and you see a lot of the major insurance companies that are still kind of promoting these. Some of them have finally stopped promoting them, but there's still some that are being promoted. So you got to be real careful with charitable lead trusts.
Okay. So, Jerry, we've got about 8 minutes left. Do you want to talk about charitable gift annuities and the reinsurance of a charitable gift annuity?
Yeah, this is very interesting. A lot of charities do not have a charitable gift annuity program because they have to become like an insurance company and insure the lives of the annuitants in their pool. And if you don't have enough annuitants in your pool, you don't have risk distribution, so it's very risky. So if you have a charity, let's suppose, now this is what's interesting. Charitable gift annuities are a very practical situation. Let's suppose senior has $1 million that he wants to give the charity. And the charity promises to pay senior an annuity for the rest of senior's life of $51,000 a year. So senior says, hey, if I live to age 110, the charity's on the hook for $51,000. So senior says, I can't afford to give that $1 million away to a charity because I need the income that $1 million generates. That $1 million generates. But if they give the money to a charity today for $1 million, the charity will give them $51,000 a year. So senior says, hey, wait a minute. I just need $51,000 a year. That's why I'm not giving you the $1 million today. This is great. Well, here's the advantage. Not only the annuity that they're giving to you happens to be worth about $687,000. So you're giving $1 million to the charity. You're getting what is a 5.1% rate of return on your million. And you don't need the million when you die, you just need the income from it. I do the charitable gift annuity. I'm getting $51,000 a year, but that annuity is only worth $687,000. So the excess $312,000 I can take as an immediate charitable income tax deduction. That's great. And I don't have to worry about living too long because the charity's on the hook for it. So this is not a bad idea. And just using this simple example is a way of encouraging people to give money to the charity. Now, the problem is the charity is acting as an insurance company. And if they don't have enough people who do this to spread the risk, because for everybody who lives too long in an insurance company, they'll have thousands of people they issue annuities to. So every person who lives too long will be offset by a person who doesn't live that, who dies unexpectedly. So they basically have what are called risk sharing and risk distribution. But a charity, what if the charity wants to have just doesn't issue charitable gift annuities because they don't have enough people to do this, and somebody wants to do this, and the charity says, we can't afford to take that risk if you live too long. So what the charity can do is say, wait a minute. I can take that $687,000 and use that to buy a commercial annuity from a reputable insurance company that will pay $51,000 a year. So the charity has just reinsured 100% of its risk, and they can do whatever they want with the $312,000.
Beautiful.
And the charity will then have to go to an insurance person who sells annuities and generate additional business for that insurance person, who will then be beholden to the charity.
Donate their profits. That's excellent. Now, Jerry, when the $51,000 a year, is that ordinary income, or is it a mix of ordinary income and return of basis?
It's nothing more than a deferred payment obligation, and a portion. It's not whatever your principal is. A portion of that 51,000 will be treated as just a return of your $688,000 cost. It's a deferred payment obligation, so a portion of that will be treated as interest income, just as you have, because you basically made an investment. You paid $688,000, so you got a basis in it of 687. It's like, and so if you get 51,000, a portion of it is a deferred payment, so there's an interest element.
Okay, and then does it have to be $1 million cash, or could it be $1 million of appreciated securities?
You mean, yeah. Well, that way you basically selling $687,000 of the say your basis in this asset is 0. So you're deemed to give $312,000 of it to the charity as a gift. You're deemed to have sold the remaining portion of it for $687,000. So that is, you've realized the $687,000 gain immediately, but under the annuity rules, you can defer the reporting of that gain to when the annuity payments are made. So it's a nice income tax deferral technique if you anticipate selling an appreciated asset for cash.
Very good. So Jerry, you gave us another example here that on page 58 that I'd like to cover if you're able to join us. Let me see when that next webinar is, because we can cover that with the business planning, because it would involve the sale of a business asset. That
oh yeah, I've done this. In other words, most purchasers of your business assets are not going to buy the stock in the company or the partnership interest. They're going to buy the assets. And a lot of the assets happen to be the goodwill, which is a capital asset. So you can contribute the goodwill portion of your business to a charitable remainder trust and then get deferred payments for that goodwill. So essentially, even though the buyer is going to give cash all up front, when you give the goodwill to the charitable remainder trust, the charitable remainder trust gets all the cash and then basically sends pays out the principal and installments in the future. So it's a capital gain deferral transaction. But the key here is it's $1 million asset. You sold 688. You get that charitable deduction up front, but that charitable deduction can save you income taxes. And if you build that tax savings up, the charitable deduction can almost equal the, when it builds up, can equal the amount that goes to charity. So it shows you it really costs you very little to give it to the charity. It's all in showing people the numbers.
And plus, if you're in a high capital gains tax bracket in the year of the sale, and you're going to be in a lower tax bracket 10 or 14 years later, when you pull it out of the charitable remainder unit trust, a tremendous amount can be saved.
Actually, we did this for somebody in Massachusetts. We love states with high state income taxes because have people in California and New York and Massachusetts, New Jersey. When they sell their business, they all intend to retire and move to Naples, Wrinkle City, as we call it. And so what happens is they realize the gain inside the charitable remainder trust while they're still subject to high state income taxes, but when they get that charitable gift annuity or the annuity from the charitable remainder trust, they've avoided state income taxes on it. So
Perfect.
we can cover that in more detail. That was very too quick. And I have remember, everything comes out of my teaching materials. And so I learned how to communicate because, when you have to teach the basic tax course to the fine arts majors of the world, you better learn communication skills.
Okay. Well, very good, Jerry. I hope you can join us July 21st. Jody, any final words? I know we ran over our time here.
No, I just, as a fundraising professional, I always rely on all of your expertise, as I really act more as a liaison for the donor. I'm just here to help fulfill the philanthropic dreams of the donors, and we always appreciate the knowledge that all of you bring to help guide the donor.
Alan,
Okay.
on July 21st, I have something at 4:30. So you got to do it before.
Yeah, we're going to do it at 12:30, July 21st. And thank you so much. Thanks for all attendees. Thanks for everyone who supports St. Petersburg College, and have a fantastic day.
Take care,
Thank
everyone.
you.
All right, take care.